Hello everyone, how's it going? My name is Yabonga Forex Lover. Welcome back to my channel. If you are new on this channel, make sure that you subscribe, make sure you like, comment and share this video. Today I will cover my personalized divergence trading strategy, and the good thing about this strategy is that you don't have to stop using the strategy that you are currently using or currently learning, but you can use your strategy in conjunction with this strategy. Basically, by using this strategy that I'm about to share now, you can greatly reduce the number of your trading losses and increase the number of your winning trades. So make sure that you tune until the end of this video. The topics of this video are as follows. What is divergence? What are the indicators used to identify divergence? How divergence is formed? The types of divergences, and last but not least, the most powerful divergence trading strategy. I will share exactly all the rules, and the good thing is you can start using this trading strategy or start adding it to your current trading strategy as soon as you finish watching the whole video. Now let's dive straight to the presentation and learn exactly what is divergence and how to use this divergence trading strategy. What is divergence? I'm not a very big fan of trading indicators, even though I believe there are indicators out there that works well when applied correctly, exactly as recommended by the creator or the seller. So I'm not the type of trader that bashes people who are using trading indicators, as long as that they are making money, because the goal is to make money and be consistently profitable. So what is divergence? Again, divergence means when the price and the oscillator does not agree with each other. It is said to be a divergence. What are the indicators used to identify divergence? Continue. An oscillator indicator can be used to identify divergence. Usually, the oscillator used consists of two levels, overbought and oversold respectively. 70 to 80 level indicates overbought, 20 to 30 level indicates oversold condition. What are the most commonly used oscillators for identifying and trading divergence? RSI, stochastic and MACD oscillator. RSI stands for relative strength index and stochastic, and MACD stands for moving average convergence divergence. How divergence is formed? Consider the price is making continuous higher highs and higher lows. So an oscillator is also something that is designed to follow price action and give signals accordingly. In the case of divergence, the indicator usually does not agree with price. A divergence is formed when price is making higher highs and an oscillator is making lower lows, and vice versa for downtrend. Types of divergences: I have bullish divergence, bearish divergence, hidden bullish divergence, and hidden bearish divergence. On this video, we will be covering regular bullish and bearish divergence. Now let's get to the moment that most of you have been patiently waiting for, ever since the beginning of this video, which is this powerful bullish bearish divergence trading strategy that you can use immediately and apply in conjunction with your current trading strategy. The strategy uses the following indicators: RSI, 20 exponential moving average, 1 hour time frame. The time that we can use the strategy is the 1 hour time frame, 30 minutes time frame, and 4 hour time frame, or 4 hours time frame. Step 1, identify divergence. Step 2, preferably divergence should occur at a level of support and resistance. Remember, if you don't know what is support and resistance, or how to identify support and resistance, I have made a video concerning support and resistance, and I will link it up at the top right corner. Make sure you click that link now and go and watch that video about support and resistance. And step number 4 is wait for price to close below the 20 EMA, then enter after the candle close. What are the rules of this trading strategy? Price must close below 20 exponential moving average, have a clear trend, always use a stop loss. Trade must offer at least 1 to 2 risk to reward ratio. Now we have come to the end of this trading strategy guide. Right now, my friends, I'm about to connect my laptop to the internet, and we will demonstrate exactly how to spot divergence on your chart, and also will demonstrate exactly how you can start trading this trading strategy right exactly after watching this video. I hope you will enjoy. Excuse me for a moment while I am connecting my phone to via the computer, so that we can access the internet and go straight to the live charts and show exactly this trading strategy. Okay, let me put this presentation on my second screen so that I can start from step 1 by adding those trading indicators, which is the RSI, the 20 exponential moving average, and also we will look for divergence on all our 3 time frames. So the first thing that I'm going to do on this chart is to clear my chart and make sure that it's clean, and use a black and white chart. Let's remove my indicator that I was testing on this demo account. Let us add a 20 exponential moving average, 20, and make it blue in color, increase the width of the indicator. I think now it's fine. What else is add an RSI. Remember, you can use an indicator of your choice, but I like to use the relative strength index, and everything I leave it at default settings. You can pause this video and copy exactly the settings, but it's just the default settings, nothing much, nothing special. So as I have mentioned, the oscillator, which is the RSI, has 70 level, which is the oversold, and 30 level, which is the overbought levels. So right now, step number 1, identify divergence. Let's go through our time frames and see if we can spot divergence on this chart. Well, I can already see a beautiful divergence on this gold chart. Let me show you exactly how you could have entered this beautiful trade on gold, which many of us has capitalized. On my live account, I did catch some pips on gold. The first thing is to identify the divergence, which is, I'll use my pen tool to make sure that I show you how did I identify this divergence. The first thing I did, I identified that this market is in a trend, which is it is in an uptrend and making higher highs and higher lows. So the next thing I did, I identified a divergence by matching this high of the price chart and this high of the chart and this high of the RSI and this high of the RSI. As you can see, the price is making higher highs while the indicator or oscillator is making lower highs. So to use this indicator, we make sure that we enter after price closes below the 20 moving average. We could have entered here and placed our stop loss around there, and as you can see, we have some sort of some minor support level here. So this is our 1-to-1 around here. This distance from here to here is almost the same as this distance from here at the entry to the stop loss, and then our 1-to-2, and the price hit the take profit perfectly. So right now, what I'm gonna do, I'm gonna look for another bullish example and then look for 2 more bearish example, and then we close this video. So right now, I said preferably divergence should occur at a level of support and resistance. So unfortunately, gold is at an all-time high, so meaning this is the first time in history that gold has hit this price level. So I can assure you that there's no resistance if you can look left in the future and try to align this divergence with the support and resistance level. And the third thing, we made sure that this divergence can offer a risk to reward ratio of at least 1-to-2 or more if you like. And then we could have ended right at the close of this bearish engulfing or bearish momentum candle, or at the retest of this minor support here at the close of this candle. Let's now look for the second chart to identify this divergence. We'll go randomly, my friends. Let's just pick maybe AUD USD. Yeah, let's just pick AUD USD. Let's hope to find an example of a bullish divergence. Let's go again and save our template so that it can be easy to identify these divergences. If you don't know, just right click, then templates, and then save template. Then I'm gonna name this template divergence. Divergence. And then save it. So now when I click on this chart, I'm just gonna right click and say template and select divergence. Here's our template for our trading strategy. Let's look at the daily. At the daily, I can already see, let me give you an upcoming trading signal for the next coming week or weeks. As you can see from here, down here, the market is in an uptrend, which is, it is a trend, one of the conditions of identifying divergence. As you can see, I foretell that the AUD/USD will drop hard, at least to here, around this previous resistance here as support right here. So I can predict the turning point of this AUD/USD daily chart. So another thing is, as you can see, the oscillator, which is the RSI, is making lower lows or lower highs. Let me say lower highs, because these are the highs. It's making lower highs, while this one is making higher high. I hope it's clear right now, my friends. So what are we waiting for before we can execute this trade, or what are the rules of this strategy? Price must close below the 20 exponential moving average. Right now, we must wait for the price to close with a momentum candle below this 20 period moving average. Then we execute our trade and put our stop loss and hold all the way to at least down here, or even at least down here. So waiting for a clear candle to close below this. And also we're gonna use our stop loss. Always use a stop loss. Remember, we put our stop loss there. And also we have at least 2-to-1 risk to reward ratio. So now it's divergence that is currently forming. So you can't enter now just because there is divergence. So we are using this exponential moving average as an extra confirmation. Also, you can use candlestick patterns if you are aware of them. So right now, let's look for two more charts that are going to have a regular bullish divergence, because I've just shown you two bearish divergences. Now let's look for charts that have a bullish divergence that has already occurred, or a bullish divergence that is yet to occur or yet to come. Now I want to select my divergence template. Let us look on the 4-hour. As you can see, my friend, I can see one. This one is, you must use and look at it closely in order to identify it. As you can see, from here, this market is making lower highs, lower lows, lower highs, lower lows, lower highs, and so on and so forth. It's in a downtrend. Right now, the market made a low and a lower low, while the oscillator made the opposite, which is the low and a higher low. Can you see? Can you see this low is supposed to be lower from the RSI? The RSI is supposed to do something like this and maybe continue like this, but instead the RSI did not agree with the price and created a higher low, just like that. So remember the rules. We enter at the close above the the 20 exponential moving average, and also our two conditions are met, which is the trend and the divergence. The third condition is put our stop loss here and make sure that to the next nearest resistance we can achieve at least 1 to 2 risk to reward ratio. So let's place our support as resistance line right there. From here is our 1 to 1, at least our 1 to 2 is achieved with this move. Our take profit could have been hit if we were using this strategy. Remember, my friends, this strategy requires patience and lots of patience. Let's look at the last chart right now. Let's have a look at maybe JPY pair, GBP JPY or something, GBP pairs, and have a look at GBP JPY and do our and insert our divergence template and look for a bullish divergence. Now let's look at the 1 hour. Look at the 1 hour. Let's scroll backwards. Right here I can see, and I want to show an example that could have worked, but it could have not reversed the trend completely. So on this example, as we can see, let's look left to identify the trend. The first thing is to identify the trend. We know that the market is trending to the downside. The next thing is to look for a divergence. When the market makes this high, wait for the market to put another, make this low, wait for the market to put another low, which is a lower than the previous low, and then look at the RSI. Did the RSI make a lower low or a higher low? As I can see, the price made a low and a lower low, and the RSI made a low and a higher low, which is the opposite of what is happening here. It's opposite, as you can see, my friend. I hope I explained it better, but I'm just trying to go a little bit faster so that I can make this video as short as possible. So what do we do after identifying this? Let's look at our previous resistance as support. As you can see, we have our previous support, and now it can potentially turn resistance. So what we do, we end up after price close above the 20 period exponential moving average, put our stop loss here, and then look the size of our stop loss. I will check some pips right now, and the potential of our take profit. So let's measure now using a crosshair so that I can show you exactly that I'm not cheating you. So from here, from the entry to our stop loss is 719 pips. So we use a calculator and say 719 times 2 is equal to 1,400 pips. Let's see if we can get 1,400 pips from there. So from here to here, we can get 1,400 pips. As you can see, that could have been our take profit. And I hope you enjoyed, and I just hope that many of you have watched until the end of this video. And thank you so much for watching this video. I will see you next time when I create the next video, which I will announce on my platforms, which is my WhatsApp and also my Facebook, and announce exactly which video, or announce the next topic that I will be talking about on my next video. So I love you guys, and take care of yourselves until next time.